Okay, hello everyone, I'm James Harte. Welcome to this Orbex market analysis session where we're going to be doing something a little different from our usual sessions. And what we're going to do is take a look back over the last year and recap 2017, and then also take a look at the year ahead, 2018. So we'll take a look at what the big consensus calls were at the start of the year, what the banks were looking for, and see how those forecasts played out. We'll look at which currencies performed best and worst on the year, and then we'll take a look at the big consensus calls for the year ahead, as well as some institutional FX forecasts. So as always, if you have any questions during the session, please just write them in the chat function and I'll stop periodically as we go along, and there'll also be some time at the end for questions. Okay, so let's jump straight in then and take a look at what the big consensus calls were at the end of 2016 heading into the start of 2017. So there were three key calls that the market was making. The first one was the Trump trade, expecting the US dollar to surge. The next was Europe to fall, expecting the euro to collapse. And then the final one, the third one, was Brexit disaster, expecting GBP, the British pound, to collapse. So let's take a look at the first one then, the Trump trade, and see how that played out. So what was the Trump trade? Well, at the start of last year, the main market focus was on the newly appointed US President Donald Trump and the prospect of massive fiscal stimulus and an America First policy agenda, which was expected to see an explosion in US rates, driving the US dollar higher. So Trump had vowed to renegotiate key trade deals such as NAFTA to benefit the US's position. He was talking about applying trade tariffs and levies to boost US profitability, as well as reforming the healthcare system and also overhauling the tax system in the US. However, the most attention-grabbing element of his promise, and the element which was most market-moving, was his plans for massive infrastructure spending in the region of $500 billion. So this was to be funded through taking on new debt, not through reduced spending in other areas or through higher taxation. And Trump's radical proposal ignited a huge rally, especially in the industrial metals complex, as speculators ploughed in, anticipating a surge in demand once the project got underway. And we also saw equity prices surging higher as well, as the president's policy proposals were fueling big expectations of a surge in growth. So given the expectations around Trump's policy proposals at the time and the impact that they were expected to have on the US dollar and US growth, investors were also ramping up their Fed rate hike expectations, as higher US growth and inflation suggested a more aggressive tightening path than the Fed was itself projecting at the time. So this was the situation at the start of last year. US rates were increasing, the US dollar was sitting just off multi-year highs, equities were surging, industrial metals were booming, and the market was expecting a really aggressive US dollar bull phase to be the key theme of the year. And the idea was, of course, given the name, the Trump trade. And this was the biggest consensus call for 2017, with everyone from major investment banks through to small retail traders looking to join the party. So how did this call play out then? Well, over a year into his tenure, it is clear that Trump has failed, the Trump trade has failed. And indeed, it failed very quickly and saw a really aggressive market response in the first part of the year, and then a continued response over the year. There's obviously been no infrastructure spending. Trump has failed so far to renegotiate NAFTA. And in terms of import levies, the only import levy so far has been on Canadian soft lumber. In terms of overhauling healthcare, Trump was defeated in his efforts to reform the healthcare system by removing Obamacare, and he's currently fighting to put his tax reform plan through. So it's clear, very clear, that Trump failed so far in the proposals which he made during his election campaign and in the early stages of his presidency, and we're yet to see any meaningful moves made by the president. So the market response to this development over the year was very swift. It became clear very early on that Trump was not delivering on his promises, and the large USD long position that had been built up in expectation of this really aggressive US dollar bull phase began unwinding rapidly. And sell-off continued over the year, and it deepened as Trump, especially around him being defeated on Obamacare, as the market quickly realized that Trump was not following through on the plan of the proposals that he'd set out during his election campaign, but also that he was struggling to get any proposals pushed through, and the market began questioning his efficacy as president. So in terms of the dollar itself then, over the course of the year, after opening in the high 102s, the dollar index fell to a low of 91 before seeing a small rebound higher over the last few months, linked to some better US data. And look, you can see the extent of the decline over most of the year with these 6 consecutive negative months, which occurred as US inflation data missed for 5 consecutive months, and this fueled a sharp deterioration in Fed rate hike expectations. So this was the main consensus call of the year then for 2017, the Trump trade, the market expecting the US dollar to explode higher, linked to Trump's massive fiscal stimulus. And it's clear at this point that the Trump trade has failed. You can see the dollar reversed, shedding over 10 points on the year, and we're still waiting for any meaningful action by the US president. So this is clearly a consensus call then that the market got wrong over 2017. Okay, so let's take a look now at the next consensus call, which was for Europe to fall as populist parties gain power. So away from the US then, the other key theme was the political situation in Europe and the increased risk of populist Eurosceptic parties coming to power in key economic states, especially such as France and Germany. So a massive increase in immigration to Europe over the last 5 years, along with a surge in terror attacks recently, had fueled a large increase in far-right support across the Eurozone. And in France and Germany, the two main far-right parties were seeing surging support in the polls, and many investment banks were highlighting the very real risk of these parties coming to power, which was seen as a threat to the strength of the Eurozone and the euro itself. So Marine Le Pen's National Front Party promised to pull France out of the euro if it came to power. And as the party breezed through the first round of voting in the French elections, there was a very strong growing sense among mainstream media sources, suggesting that the euro would be rocked by a surprise outcome. So obviously you have to remember last year, over 2017 that we just come off the back of that surprise Brexit referendum decision where the market was caught off guard. We had the US elections where once again the market was caught off guard. And so ahead of these elections, there was a very strong sense that the polls were unreliable and that there was a very strong possibility of a surprise outcome happening once again, especially given the surge in support for these far-right parties. So this was the other key consensus call then. The market was highlighting the elevated uncertainty around these European elections and the prospect of these far-right anti-Euro, anti-EU parties getting into power, and these was expected to weigh on the euro across the year and send the euro lower. So how did this second consensus call of 2017 play out? Well, ultimately, Le Pen's party failed to come to power in France, and as focus then shifted to the German elections, the far-right AfD party also failed to come to power, although they did see a surge in support which allowed them to gain seats in the Bundestag for the first time in their history. However, once again, mainstream media highlighted that the Eurozone was on the brink of collapse and that the euro was going to collapse and that these far-right parties were going to come to power across the Eurozone and drag the euro apart. And it's very clear now, once again, that this didn't happen. And as with the French elections and the German elections, smaller elections also, such as the Dutch and Austrian elections, also saw populist parties being defeated, meaning that all the fear and the bluster that was being peddled, especially by mainstream media sources at the start of the year, had virtually passed by summer and then was totally forgotten into the second half of the year. And clearly the euro remained unscathed and continued to strengthen over the year. So looking ahead then, we have of course got the Italian elections coming up in the first part of next year. But again, on the back of these outcomes across Europe so far, the outcome is seen as being at worst rather, a hung parliament, but the far right are not seen coming to power. As we've seen across the Eurozone in these elections, although we've seen a pickup in support for far right parties, it seems highly unlikely that they're going to come to power. So again, looking at the price action of the euro, then you can see I've highlighted here its moves. This is a monthly chart. The moves of the euro over this year, far from falling below parity, as many calls at the start of the year were suggesting, the euro actually enjoyed a really strong rally. And where the dollar index had that large bearish decline of 6 consecutive negative months, you can see the euro enjoyed the exact opposite, and we had 6 consecutive positive months. So this was a really strong rally for the euro. You can see that we broke back above the 2016 and 2015 highs. So it's very clear once again that the market got this big consensus call wrong. So the market was wrong about the Trump trade. The dollar didn't explode over 2017, and the market was wrong about Europe falling apart on the rise of the far right. And the euro didn't fall below parity. Instead, we traded back to fresh 3-year highs. So staying in Europe then, the next key theme at the start of 2017 and one of the other big consensus calls was that the UK economy was going to disintegrate due to Brexit and that negotiations were going to fail. Brexit negotiations were going to fail. Okay, so this was another really strong consensus call at the start of the year. Many investment banks were highlighting catastrophic risks from Brexit, saying that the UK would become a second-class economy and that the pound was going to collapse. So how did this play out then? Once again, you can see that the market got this wrong. Okay, so UK data following the Brexit referendum remained really strong, and over the year, the UK economy has visibly strengthened, with growth and inflation both rising, unemployment falling, and manufacturing and service sector strength remaining firm. Okay, so again, the market was wrong about this call. Instead of data weakening, the economy falling apart and the pound collapsing, we actually saw the economy strengthening, data improving, and sentiment improving as well, with the pound rising. Added to this was the fact that the market was also taken by surprise as the Bank of England began striking a much more hawkish tone in its meetings, highlighting the likelihood of a rate rise being necessary given the trajectory of the economy. Okay, so this was the other call that was tied into this whole Brexit disaster scenario, was that all of the uncertainty around Brexit meant that there was no way that the Bank of England could even contemplate raising rates, and it was far more likely that if they were going to move again, it would be for further easing. So this was another really strong call at the start of the year. We'd obviously seen those massive declines over 2014, 15, and 16, and the market was looking at 2017 as being another huge leg lower for the pound, linked to these Brexit concerns and linked to the Bank of England having to stay neutral at best, but also more likely having to cut rates. However, once again, the market got this wrong. So UK economic data improved over the year, highlighting positive trajectory. Inflation surged above the bank's 2% target and recently jumped above 3%. The Bank of England very quickly in the year shifted to highlighting a more hawkish outlook, and then in November they actually followed through and raised rates for the first time in a decade, and have also raised its inflation and growth outlook over the horizon period. And with inflation still surging, as I said, jumping above 3%, the very real risk now is that the bank are actually going to be tightening at a quicker pace than is currently expected. So looking at the price action in sterling, then you can see that once again I've highlighted the yearly period on the monthly chart. So we open around 123.50 on the year, traded back up to highs of 135.60s, and we're currently sitting at around 134. So we're still up over 1,000 pips higher on the year. So when we opened the year, the market was looking for cable to continue to sell off and for another big leg lower, but instead we've recovered over 1,000 pips to the top side. So these were the three main consensus calls of 2017. The market was looking for the US dollar to explode on the Trump trade linked to Donald Trump's massive fiscal stimulus. The market was wrong. The dollar collapsed. The market was looking for Europe to be rocked by the rise of the far right and looking for the euro to fall consequently. Once again, the market was wrong, euro rallied. And then finally, the other consensus call was that the UK economy was going to collapse around these Brexit negotiations. The uncertainty was going to keep the Bank of England sidelined, possibly see them cutting rates again, and consequently, the pound was going to collapse. And finally, once again, the market was wrong, and sterling traded higher by over 1,000 pips. So those were the key consensus calls then that played out over 2017. And to get a better sense of how they affected the market, we can look at the best and worst performing currencies of the year, because this really sort of highlights the disparity between those big consensus calls and what actually transpired over the year. So the best performing currency of the year then was actually the euro, which rose over 12% against the dollar, despite all of these bearish predictions at the start of the year. So what was behind the euro's bumper year then? Why did we see this large 12% rally when the market was so convinced that the euro was going to crater over 2017? So there are a combination of factors then which fueled the euro's rally. Namely, these were diminished political risk in the eurozone, stronger data and ECB tapering, and then also the weaker US dollar. So as we discussed then earlier, at the start of the year, the market was highly concerned that the euro was going to come under significant selling pressure due to the elevated uncertainty around the eurozone elections. So the prospect of the far right coming to power, anti-euro parties coming to power in the eurozone, led many analysts and commentators to believe that the euro was going to trade lower over the year, as this uncertainty was going to make it an unfavorable investment for capital. However, as it quickly became clear that these parties were not gaining power and the political status quo was being reaffirmed in key member economies, the market was able to return then to concentrating on core fundamentals, which were turning increasingly more positive for the euro. So we've seen data over the year continuing to fly in the face of those who forecast that the euro was going to fall lower. And in response to this, the message from the ECB became increasingly more constructive. So the bank was widely expected to announce tapering during the summer, in line with various ECB comments and firm data. However, the ECB kept policy unchanged over the summer and instead signalled that it would discuss the issue of tapering at its autumn meeting. So the ECB did indeed announce tapering at its autumn meeting, although the level, which was a reduction of 30 billion euros a month, undershot market expectations, especially so as it was also announced that along with the reduction, which was smaller than expected, the duration of the programme would be extended in line with the bank's lower for longer approach, which ECB Chief Draghi says is necessary to maintain the sustainability of growth in the eurozone. So Draghi understands that as the economy is improving so well, that removal of accommodative monetary policy is necessary, but also realizes that some accommodative monetary policy needs to stay in play to keep this growth sustainable and to make sure that the recovery doesn't falter. However, with data continuing to print so strongly, the market is suspecting that the ECB will actually end up tapering and removing accommodative monetary policy at a quicker pace than is currently expected, at a quicker pace than the ECB is currently giving on. So this is creating all of this demand in the euro at the moment, as speculators believe that the euro is going to continue rising. And then the final piece of the puzzle for the euro over 2017 was the underperformance of the US dollar. So as we discussed before, with Trump's failure to deliver any meaningful policy changes, especially the lack of infrastructure spending, which really got the market so stoked up and excited at the start of the year, the US dollar sank lower over 2017, and the Fed were forced to stay on the sidelines right up until just this month, as data over the first half of the year showed inflation undershooting expectations for 5 consecutive months. So with all of these factors working together then, the euro enjoyed a solid gain over the year and is in great position heading into 2018. Now, while the euro was the best performer of the traditional G10 currencies, no discussion on currency performance this year could really be complete without talking about, wait for it, Bitcoin. Okay, so the explosion in popularity and the price, especially, of this digital currency has been one of the biggest news stories of the year, and it seems that every person is now talking about Bitcoin. So, sitting at just under $19,000 per Bitcoin, the price of this digital currency has risen around 1,900% this year in moves which haven't been seen since the tech bubble of 2001. So this has just been a crazy period of exploding prices for the digital currency. And surging popularity, increased usage and adoption by businesses and more mainstream retail areas have transformed Bitcoin from an underground currency which was maligned by governments to a real contender which is now challenging the role of traditional currencies. And indeed, the entire cryptocurrency space has been blowing up this year, with many other smaller cryptocurrencies experiencing even bigger gains, albeit at smaller market caps and lower prices. So Ethereum, which is the second highest traded cryptocurrency, has risen an unbelievable 8,673% this year at the time of writing, while Litecoin, another key currency, cryptocurrency, has also exploded 7,144%. So it really puts the euro's meagerly 12% into perspective, but albeit these investments are the source of great debate at the moment, but it's definitely going to be really interesting to watch how they perform over 2018 and see how the world responds to them and what happens next in this space. So these were the best performing currencies of 2017. Let's now take a look at what the worst currency was. And the worst currency was, of course, the US dollar. So this actually turned out, again, to be a major embarrassment for many of the investment banks which were calling for a surging dollar over 2017. And it really was a combination of Trump's failure to deliver any meaningful policy adjustment, along with the Fed's cautious approach over the year, which saw traders unwinding the large US dollar long positions that had built up around the beginning of 2017. So with inflation falling below forecast for 5 consecutive months over the middle of the year, the Fed started backpedaling on earlier hawkishness and instead moved firmly to the sidelines. So while the market had been expecting further rate hikes over 2017, the Fed stayed on the sidelines all the way up until this month, the final month of the year, where they finally moved on rates. And the Fed's neutrality over the year was amplified given that other G10 central banks were taking a hawkish turn. So we saw the Bank of Canada and the Bank of England both raising rates. We saw the ECB announcing tapering. And so with these other central banks starting a more hawkish shift, this actually put downward pressure on the US dollar as investors started turning to other currencies for their investments. Okay, so that was the best performing and worst performing currencies of the year. Let's now quickly take a look at what the best performing currency pair was. So again, we're just sticking with the majors and the crosses here. And the best performing pair of the year was actually the cross pair, the euro against the New Zealand dollar, which enjoyed a really textbook bullish trend over the year, rising in stair-step fashion from start to finish, peak at nearly 3,000 pips on the year. So this was a massive rally and a really straightforward play for anyone who got involved, with many breakout opportunities in this pair over the year. And the driver behind this move was essentially a combination of the fluctuating risk environment along with the dynamic environment of central bank monetary policy. So the diminished risk in the Eurozone, the diminished political risk in the Eurozone, along with increased expectations of ECB tightening, has seen the euro exploding higher against the New Zealand dollar, which has suffered over the year from receding Reserve Bank of New Zealand rate hike expectations. So again, if you were involved in this trade, this was a fantastic move over the year, and if you weren't, better luck next year, I guess. Okay, so we've looked at the big consensus calls for 2017 and where they ended up. We've taken a look at the best and worst performing currency pairs and the best performing and worst performing currencies and the best performing currency pair, which was the Euro NZD. So let's now take a look at what the key themes are heading into 2018 and the big consensus calls that the market is making now as we head into the new year. So the first big consensus call for 2018 is that growth in the Eurozone is going to slow down and growth in the US is expected to ramp up. So following an expansion in growth this year in the Eurozone, most analysts are expecting to see a loss of momentum over next year, and the Eurozone growth figure is currently forecast to fall back from 2.3% to 1.8% on average. And the ECB has highlighted its intention to run quantitative easing at a lower for longer pace in order to continue supporting growth, and as such it's likely that investors will become frustrated with the ECB's lack of tightening, which is expected to weigh on euro sentiment. Conversely, a lot of analysts are also expecting that the US dollar will re-enter a bull phase linked to higher than expected US growth over the year, with growth forecast to move up to 2.5% from 2.2%. Growth at this level is expected to be enough to allow the Fed to hike rates 3 times over the year, as is currently projected, which is expected to fuel a substantial US dollar rally. So this is the first key consensus call, that the euro is going to, that the Eurozone is going to see a suffering in growth, and that the US economy is going to see a big increase in growth. So the risk to this view, however, is that with data continuing to strengthen in the Eurozone, it seems that there is a strong risk the Eurozone slowdown call is wrong. Okay, so the latest data is showing that, for example, investor confidence in the Eurozone is at its highest level for a decade. And the ECB's current guidance is based on data thus far. So if the data continues to strengthen at the current rate, it's likely the ECB will become more comfortable with normalizing policy at a quicker rate than is currently scheduled. Now, investor positioning in the euro, as shown by the latest COT data, shows that long positioning has now moved to its highest level since 2007. Okay, so the amount of people expecting the euro to go up has moved to its highest level since 2007. Now, obviously, this presents the risk of a squeeze on any data weakness or any negative comments from the ECB, though with positioning so firmly high, the trend is clearly to the upside, and this exposure looks set to continue. Now, from a technical perspective, it's also worth pointing out that the euro is currently on course to print an engulfing outside year. Okay, so the range of this year as a candle is likely at this point to engulf the prior year, and this is an extremely significant development, as this will only be the 4th such occurrence since the euro began floating in the 1970s, and each prior occurrence has led to a reversal, a continuation of the reversal over the following year, with the moves over the next year averaging 20% and the smallest move being a 13.5% run to the downside in 2015. So if the euro closes at around current levels, that means that we've got a bullish engulfing candle on the year, and that we could be looking to an upside run next year of around 20%, 13 to 20%. So this would be in line with the Eurozone slowdown call being wrong, with data continuing to print strongly, and with the ECB removing accommodative monetary policy at a quicker rate than is currently expected. Okay, so the other key consensus call then for 2018 is that the Japanese yen is going to continue trading lower. So Japanese yen downside has been a very popular market expression over 2017. We've seen traders looking to capitalize on the growing monetary policy divergence between the BOJ and other central banks in the G10 space. So with the Bank of Japan having reaffirmed its commitment to easing over the year, the divergence between itself and the Fed, ECB, Bank of England and the Bank of Canada has grown strongly. Now, the Bank of Japan's program of QQE with yield curve control has been extremely effective at keeping Japanese government bond yields suppressed over the year. Rising global yields have been a common theme. So this has created really strong downside pressure in the yen, and this has been reflected in institutional positioning, which has seen short exposure rising to record levels. So the consensus then is for Bank of Japan dovishness to continue over 2018, while the Bank of Japan is expected to remain on hold. However, recent comments from the Bank of Japan Governor Kuroda actually highlight the risk that the Bank of Japan is debating the continued use of easing. So, speaking to traders in Zurich recently, the BOJ chief referenced a reversal rate, which is the first time he's used the term, and essentially refers to an interest rate level that is too low to continue stimulating the economy and makes it unprofitable for banks to continue lending. Now, although this term was noticed by traders at the time, it didn't provoke a reaction. However, when Kuroda used the term again 2 weeks later, we saw some strengthening in the yen, and investors are now beginning questioning whether Kuroda and his team are considering an adjustment, such as lifting the cap on the benchmark JGB rate to above the current level of around 0. Now, with Japanese yen short positioning at such extreme levels, there's plenty of room for sharp, sudden moves higher in response to any further comments of this sort. And if the bank does make a move of this manner over 2018, it would likely fuel a really strong bullish phase in the Japanese yen. Now, it's worth pointing out that Kuroda has since confirmed that his comments were not intended to signal a potential change in policy, but the market will obviously be closely watching upcoming BOJ communications for any further clues. And of course, we have the Bank of Japan monetary policy meeting this week, so traders will be particularly paying attention to that for any clues, early clues on the Bank of Japan's outlook for likely movements over 2018. Okay, so to conclude our 2018 outlook then, let's take a look at what some of the major investment banks are forecasting for the euro, for sterling, and for the dollar yen. So let's kick off with the euro then. Okay, so you can see the euro then. Barclays are looking for the euro to hit 117 over Q1, 119 over Q2, 122 over Q3, and 124 over Q4. We've got Morgan Stanley forecasting 120 in Q1, 123 in Q2, 118 in Q3, and 117 in Q4. Credit Agricole 122 in Q1, 123 in Q2, 124 in Q3, and 125 in Q4. And finally, Societe Generale forecasting 121 in the euro over Q1, 123 in Q2, 125 in Q3, and then finally 127, the most bullish call, for Q4. So the broad view here is that the euro is going to strengthen throughout the year, ending in 2018 around the mid-20s. So the lowest call there is 117, the highest call is 127. So roughly 1,000 pips worth of range there. But the general idea is that the euro is going to strengthen over 2018. And again, this view is in sync with the idea that EU data is going to remain strong and that the ECB will taper at a faster pace than is currently expected. And it also suggests that US dollar weakness is likely to continue. Okay, so let's take a look then at what these banks are forecasting for sterling over 2018. So, sterling against the US dollar, Barclays are forecasting Q1 to end 130, Q2 to end 132, Q3 to end 136, and Q4 to end all the way up at 146. Morgan Stanley are forecasting 125 in Q1, 120 in Q2, 127 in Q3, and 124 in Q4. Credit Agricole are forecasting sterling 136 in Q1, 137 in Q2, 138 in Q3, and 140 in Q4. And then finally, Societe Generale forecasting sterling 129 in Q1, 128 in Q2, 129 in Q3, and 130 in Q4. So again, the broad view here is that sterling is going to rise against the US dollar throughout the year, with Barclays suggesting that we're going to see a move back up to near 150. So again, this move is consistent with the view that Brexit negotiations will leave the UK economy unharmed, that they'll be successful, and that the UK government will be able to get a favourable deal for the UK, allowing them to transition harmlessly out of the Eurozone and continue trading with the Eurozone in a mutually beneficial way. This is also consistent with the idea that the Bank of England are likely going to increase rates at a faster pace than is currently expected due to the improvements in the UK economy. Okay, so let's finally take a look at the forecasts for the dollar yen. And we have Credit Agricole forecasting the dollar yen to end Q1 of 2018 at 108, Q2 110, Q3 112, Q4 112. Barclays forecasting Q1 112, Q2 110, Q3 108, and Q4 105. Morgan Stanley are forecasting sterling 114 in Q1, so the biggest call for Q1 there, 112 in Q2, 108 in Q3, and 105 in Q4. And then finally, Societe Generale forecasting dollar yen to end Q1 at 112, Q2 113, Q3 113, and then Q4 110. So we've got a bit of more of a split among the views on the dollar yen. So most banks are looking for some initial strengthening across the year. So they're looking for the dollar to rise against the Japanese yen over the first half of the year, but then half see a fall back over the second half of the year. And so this again could potentially be linked to a shift in Bank of Japan policy. Okay, so if people are starting to debate whether the Bank of Japan itself is debating the continued use of easing, this brings the risk in that over 2018, if data increases and if data improves rather, if the bank judge that having interest rates so low is no longer effective, then we could see a shift in policy, which would likely cause Japanese yen to rally, taking the market by surprise. Okay, so those are the big consensus calls for 2018, and those are the FX forecasts for 2018 from some major investment banks. And that wraps up our 2017 review and our 2018 outlook. So I hope you found all of that useful and enjoyable. And whatever you're doing over holidays, I hope you all have a relaxing time and come back rested and refreshed, ready for trading in the new year. So just before I go then, are there any questions I can answer for anyone? Brilliant. Okay, well, look, I'm glad that you've all followed along and that's been useful and helped you. And thanks for those comments. And look, I'll catch up with you all in the new year. So thanks a lot, everyone. Take care now and enjoy your time off.